In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels, and to all of our YouTubers. And Stu,
hey,
that was a fun day.
That was a fun day.
I saw the SPY up about.
It was really fun if you were long NVIDIA.
If you were long NVIDIA, it was really fun. I think we were up about 1% on the SPY. Q's up what? 2.5% maybe.
2.5%.
Yeah, about 2.5. A lot of that was led by NVIDIA and Microsoft. What was Microsoft up about 4%?
Almost 4. Yep.
But NVIDIA was up how much?
24%.
Say that again. Man, that is
I can't even get it out of my mouth. 24%.
Yeah, we've seen stocks certainly fall that much, but to gap on an earnings, not a buyout.
Not a buyout.
On an earnings, that is incredible. But it's all this hype on AI now, so certainly opening up lots of opportunities. But we thought this would be a really cool topic for people and to talk about because a lot of times when we get into very high implied volatilities, things that we see in unusual options activity, people turn to vertical spreads. But we hear so many different myths about verticals, really about all strategies, but especially vertical spreads. So we thought what would be a very cool Coach's Corner here for everyone today is to talk about 3 really popular myths of vertical spreads. Now, remember, there's a lot more to them. I know, Stu, you hear them every single day.
All day, every day.
All day, every day. We hear them a lot in Q&A, but these are probably 3 of the more popular ones.
Okay.
Bigger traps that people step into. And I know you're going to be aware of these once you see them, but be a little bit of a surprise for you.
Come at me.
We're ready here. So here we go. We're going to start off with Chalk Talk. So for anybody who's new, this is our little kind of a brain teaser question. It's not always related to the topic at hand. Sometimes it is, sometimes it isn't. But we want you to think about this, that you own the 100-105 vertical call spread. So by owning it, it would be a debit spread. And the question is, are you at risk if you are assigned early? This is one of the big fears that a lot of people have, especially during high volatility. So that's the first question. And again, please write down the answer.
Commit.
Commit to it, right. Question number 2 is a follow-up that says, what if you sell the 100-105 put spread? Now, by selling the put spread, we will have the same profile. They will both be bullish, whether you buy the call spread or sell the put spread. That doesn't
What do
make
you mean,
sense.
Bill? One's going to be debit spread and one's going to be a credit spread.
One's a debit and one's a credit.
And they're the same thing.
They are exactly the same thing, not counting any skews in the market, but yes, they are exactly the same thing. And we're going to show you why in a little bit. But those are the questions we want you to think about right now. All right. So if you're a options trader or you trade vertical spreads, think about those and jot down your answers. Okay. So with that, let's start with our three, at least of the most popular myths. Here's the first one. I know you hear this all the time, Stu, that you generate cash with a credit spread. We hear so many times people say, oh, I've got this retirement account and my advisor told me that I can generate monthly income by selling these credit spreads.
Yeah, that guy should get a new career, whoever says that.
You hear it all, it's all over the internet. Everybody talks about the credit spreads as this magical trade because people just throw money at you.
Yeah.
And they're going, okay, well, is that really true? And one of the things that we like to show is it's really hard to make good decisions if you have these myths and misperceptions about the way that strategies, options, things like that work. You can't make good decisions based on false perceptions.
Right.
So let's take a look at this first one here. We're going to look at two different spreads here, Stu. We're going to look at a 100-105 debit spread. We're going to say that it's trading for 3. And we're going to compare it to the 100-105 credit spread. So again, let's say that this is the call spread on top. It's the debit spread. We're buying it. And then we're going to compare it to the 100-105 credit spread, which would be the put spread for 2. Now you might think, that's kind of unfair. Why would I say that you got to pay 3 and only receive 2? What's going on there? Can you give us a quick explanation why I chose those prices? Why would that be something realistically that we would see in the
3 words, put call parity.
Ooh, yep, very good.
Right. Yeah, they are synthetic versions of one another.
Correct. If you pay $3 for a $5 spread, the maximum gain is 2. And so therefore the credit spread, what's called the corresponding spread, meaning that we're going to look at the same strikes, same expiration. We're just going to shift our eyes from the call side over to the put side.
Very, very important that we realize that, like what Bill just said, it is the same expiration, same strike prices, no variation in interest rates among anything. This is the same thing. It's called like he said, the corresponding spread. It's just the other side. It's one's a call, one's the put. They're synthetic versions of one another. At the end of the day, they're exactly the same.
Yep. So if we could pay 4 for the debit spread, we would expect the credit spread to be selling for 1. If we paid $2.50 for the debit spread, we would expect the credit spread to be selling for $2.50. That's what they mean. They always have to add up to that difference in strikes.
Now we keep in mind that that's what we can expect. There are times in the marketplace where things get a little off kilter. And those are opportunities that we can, if we have the wherewithal to, what's the word I'm looking for? Like to notice them, to see them. That's a good opportunity to try and lock in some gains. They do occur, not too often, but they do occur. And it just means that one or the other relative to the other is not a fair value referencing the other one. Right. And that creates an opportunity.
Those are the opportunities, correct. So these are the two that we're going to work with here for a while. So let's start with a debit spread. Let's say that we buy the $100 call and we spend 10. Doesn't really matter what we pay for it. I'm just picking some numbers. We sell the 105 call, we collect 7. And in this example, that would be a net debit of 3. Now, remember, we could have paid 15 and sold for 12. That's what it means to be a net. It's just the net cash flow. So again, it doesn't really matter what the individual numbers are.
No.
The fact is it's a net of 3. Now, the thing that you have to understand here for all of our traders out there in YouTube land is that Stu and I often refer to this as an asset spread, and that's probably something you haven't heard of. And we like to do that to emphasize that when you buy a spread, whether it's calls or puts, you are the buyer. And what happens in this case, if we buy the $100 call, you have the right to buy shares at 100. And if you sell the 105 call, you have the obligation to sell at 105. It's really a potential obligation if you get assigned. But take a look at those two things. if you buy stock at 100 and you sell it for 105, you could potentially gain that $5 difference in strikes. If we bought the 100 and sold the 110, it might be worth 10. But
Bill,
the point is that it can grow in value.
Can I step in and just make
Of
like
course.
one blanket statement here? In trying to learn what options are and how they work and theory and, you know, all the cool stuff that goes along with it. Right here, what Bill's putting up on the screen right here, this is what it's all about. This is where it all starts. Options are rights and obligations. Owners have rights, sellers have an obligation. It always comes back to this.
Yep.
It always.
If traders would remember that, they probably wouldn't harp so much on positive theta and being the option seller. It has its places, but it's a liability. You can't forget that. You're not getting paid to accept an asset. So the thing that we're trying to show you here is that you are paying money, net debit, because it's something that might grow in value. So here's the resulting what's called a risk graph. So we have the bends. We always get a bend at our strike. So here's our long 100 position right there. There's our short 105. So we get kind of this double hockey stick graph. Here's our maximum loss of 3. Here's our max gain of 2. All right, so I want you to keep this picture in your minds. 3 on the left, 2 on the top. And let's now move over to the wonderful credit spread that everybody talks about. And this time we're going to say that you're going to buy the 100 put. Let's give it a number, 7. You're going to sell the 105 put, and let's say that you collect 9. On a net basis, you've collected 2. But, however, this is a liability spread. And the reason is that if you look at this, you have the right to sell shares for 100, but you've got the potential obligation to buy for 105. So what happens?
Hold on. Time out. You're telling me that you want me to enter into a combination of options here where I'm obligated to pay 105, and as a consolation prize, you're going to give me the right to sell that 105 purchase at 100? Is that what you're trying to tell me?
If you put the credit spread on, then you're the one who did it. That's exactly what I'm trying to tell you. Yep. If you do a credit spread, you are exposing yourself to a liability equal to the difference in strikes.
Why would I do that?
It's a good question. Well, part of it is we do get a credit. We do get paid up front. But the scenario here is a little bit more akin to an insurance company. If you have an insurance policy on your car, you're going to pay a whole lot less than the potential payout of that policy. Otherwise, you would just self-insure. If they said, we're going to charge you $30,000 a year to have a $30,000 potential collection, so I'll just stick it under the mattress and insure myself.
You know, hold on, time out again. That little side note here, this has nothing to do with well, kind of does a little bit. Self-insure. If you want to sell the 105 put for $9 and self-insure the downside,
right?
In other words, don't buy the right to get out. Just have complete exposure to the downside. Then don't buy the 100 put. This is this is what's known as the naked put.
The naked.
This is also what's known as the covered call. Right?
And it's synthetically is a covered call.
Outside, yep. Right. So, you know, it's just buy, you know, selling them at 9 is nice. You know, I get that too. Oh, should I sell these? Should I sell these? Volatility is 300. We saw that in the banking stocks last month. Volatility is 300. Should I sell them? I don't know. I'll let you know because I don't know where the stock is going. They're that way for a reason. But if you're looking to sell them, sell them. It's okay. It doesn't make you a bad trader. But what you need to do is you need to realize that you have to ask the question, do you want an out? The out in this case would be
the 100 put.
The 100 put. If you don't want an out and you want to self-insure and just say, you know, I'm good. Let me see what happens. I'm good with whatever happens, and I'll cover the loss myself if it occurs. Then don't worry about it. Just go with the downside.
Yep. So the thing is, by entering the spread, we have the potential to lose the $5 difference in strikes. There's no asset in this equation.
Other side of the trade.
Other side of the trade, right. Somebody bought this spread who would have the opposite set of cash flows.
So again, yes, the benefit in doing it is that you get paid cash up front, but you have the potential to lose the $5 difference in strikes.
Do you really
now-
get paid?
We're going to hold that thought. We're going to come back and take a look at that. But right now, I want you to take a look at this spread right here. We're going to buy the 100, sell the 105 put. This becomes our risk graph. So notice that with the debit spread, we started over here with a 3 debit. We said, okay, it might increase by 5 points and give us a 2-point maximum gain. What's happening here? We're starting on this side of the equation of our risk graph. We're getting a $2 credit, but we're exposed to a $5 potential loss, which means on a net basis, we could end up with -3. So let's go ahead and compare these now. I said to remember the first one, and it looks exactly like this one. So the first one was to pay 3, potentially make 2. The second one was to receive 2, but potentially lose 3. Kind of looks the same there, Stu. Now, here's where people make their mistakes. This is where the big myth is. They'll hear about the debit spread and they say, oh, yes, if I buy this, I've got to spend 3. That's cash going out of my account. However, because I'm such a smart trader, I realize that over on this side of the board, it's a credit spread and I can get $2 cash parked in my pocket. So, hey, who wants to spend money when somebody's willing to pay you? Not true. This is the myth. We're not done yet. This is called a credit spread just because of the differences in the value of those options. You are selling the more expensive option. We were selling the 105 put. Because this is a potential $5 liability, the broker says, hold on a second, Mr. Trader. We're going to debit your account $500 or $5 because of this liability. See, the broker doesn't care about your maximum gain. The broker cares about the maximum loss and guarding the risk. So do you get $2? Absolutely, positively true. Look at it. It's parked in your money market. But the myth is, the thing that people don't see is that the broker also debits your account. Not a true debit in the fact that they've wired it out of the account somewhere, but they segregate it. They're not going to let you spend this $500 until this position is closed out.
You mean I can't request a check?
Cannot, not for that $500.
I mean, I could, but they'll tell me to go play in traffic, right?
Well, either that or most people would have what's called margin cash available or check writing ability, which is going to get reduced by $500. That's another way to check it. Yeah. And so if you have any over and above that, you could certainly get a check. But there's $500 that is being withheld. Yes. So on a net basis, what happens? Debit or debit? You want the credit spread? It's a debit spread. You want the debit spread? It's a debit spread. You see where we're going? They both result in debits in the end. So if anybody tells you to do the credit spread because you can generate income, it is absolutely false. It's a myth. And unfortunately, it's one that everybody believes, Stu, because everybody believes it. And it just keeps getting perpetuated that the thing to do to generate income is to do credit spreads.
And how about this, Bill? If you're looking at a credit spread because somebody told you it's a good thing to do to generate income, and you sell it at, say, $2, like we're talking about here, without looking at the debit spread, the same spread on the other side, that could be trading, possibly could be trading for less than 3.
Might be trading for 290.
If that occurs, and it does, if that occurs, then you are making a donation to the marketplace.
Yep.
Pay to the order of the markets.
Yep. In that case, you'd have been better off with a debit spread.
Yep. Without looking at that, it's just foolish not to look at it. But go ahead.
Yep.
Sorry.
Yep. That's where professional traders make their distinctions. Are there skews going on in here where maybe I could pay 290 and have, pay 290 and have 210 for a maximum gain? Well, yeah, maybe the debit spread would be better. Or maybe we're going to get that over here. Maybe we get a credit of 210 and a max loss of 290.
I'm going to say it a little nicer than Bill. This is where a professional trader is going to pick off the retail person.
Oh, for sure.
Doing.
Yeah, that's the edge that they're looking for.
Yeah.
So don't be that person. Don't do a credit spread because of the word credit.
Love it.
Do it either because of the ease of the morph or because there are skews in the market. So this is a very big myth that is out there in the markets. Okay, so we want to make sure that everybody's clear with that. All right, let's take a look at myth number 2. And before we do, as always, for anybody who likes this kind of information and is interested in options trading, please visit us at marketrebellion.com /get started. Lots of free stuff on there. Great written materials, videos, lots of things to help you get started and make better decisions. So myth number 2.
Before we go there, 1 second. I could even make an argument on the debate stage. I could even make an argument that the ease of what's the word? Ease of morph argument is non-existent. It looks like it could be, and if you don't know synthetics, it is. But
True.
if you know the theory behind synthetics, it doesn't make a difference.
It doesn't, but it can make it a little less hairy
Cumbersome.
without getting into big blast of thunder. I don't know if you heard that. I hope my internet holds up. But it might be a little more cumbersome. But you're right. In the end, it just doesn't matter.
We'll do that one in another coach's corner.
That'd be a good one for the future. All right, let's take a look at myth number 2. We hear this a lot too, because we often teach that you use deltas for things like stock replacement. We tell people to look for maybe an 80 to 85 delta. Lots of strategies where we tell people to look to base it on deltas. A lot of delta neutral strategies. Obviously, look for a delta close to 0. And people say, well, what delta should I use for a vertical spread? Not so easy. Now, that's not really the best way to make your decision with verticals, and here's why. Let's look at the 100-105 vertical spread. This is one we just looked at. Now, remember, this black curve is called the expiration graph. It only applies right at expiration, meaning at 3:59 p.m. Eastern time. Prior to expiration.
I'm having a little chuckle with myself here. How did the NVIDIA 1x2 front spread delta neutral work out today?
That didn't work out real well at all.
Delta neutral. How do I lose?
Well,
and
that's
directional bias. How do I lose?
And that's a good point. Delta neutral just means you're starting out. It doesn't mean that it stays 0. It's not a T-bill. Right. Yeah. No, it just means that's where you are right now.
Mm-hmm.
So here's our expiration graph. But prior to expiration, we might have this kind of a risk graph. And over time, the left side sinks down towards the black, the right side moves up. So for example, this might be 30 days to expiration in blue. Maybe that's 25. And what happens is we just start stepping like this as we get closer and closer to expiration. So again, the thing to notice is that on the left, we are sinking. That's your negative theta side. On the right, we are rising. That's our positive theta. So they are different depending on where the stock is when we put the trade on. So here's why I have to be careful about using deltas to choose your strikes. Let's say the stock is 100. We're going to look at the 95-100 for 3 and the 100-105 for 2.
Mm-hmm.
These are both debit spreads, by the way. So the question is, what are the deltas and how will the values change as we get closer to expiration? All right, so let's start with the 95-100. Here's our bend at 95 and at 100. That's how we can tell it's a 95-100. The green is the current curve. Now let's overlay the 100-105. There's our bend at 100, another bend at 105. Its current curve is in red. So remember, the stock is right here at 100. And take a look
at the deltas. They're the same.
They're the same.
Yeah.
So if we tell you, oh, you should use a delta of 35 or a delta of 50, you might say, oh, the 95-100 fits the bill. Or somebody else goes, no, it's the 100-105. And if you're going to base it on deltas, there's lots of answers that could be right. But watch how they differ over time. So the 95-100 is going to do this, and the 100-105 is going to do this. Notice the 95-100 is appreciating. The 100-105 is depreciating.
And what you want to ask yourself as a trader is, what am I looking for? What do I need to happen to make money?
Yep.
How do I win? How do I lose? What's the dynamic here? Which one fits my goal best according to direction, magnitude, and speed?
Yep, we might, all things being equal, if we start up here, we're going to receive a smaller potential gain, but we have a higher probability of it. Down here, it's going to be cheaper because it's out of the money, but we have positive gamma. We might, we need the stock to move, but we can potentially make more money. It all depends on what you're trying to do. The thing that we're trying to show you here is that even though both traders, let's say, started with identical deltas, or maybe it was the same trader who was just confused about which way to go, Very different outcomes. If the stock just kind of hangs around here, one's going to grow towards the maximum value, the other sinks. And it doesn't make one right or wrong, it just makes them different. So
Yeah,
here
and that's your job as
Yep.
traders, people, as risk managers. You're not reward managers. I've said that before on here. You're risk managers. Your job is to see all these lines on here, to see what will happen to your position
over time.
as time goes by, as stock moves, as implied volatility moves around,
Yep.
even as interest rates change. It's your job as risk manager to take in all the different things. It's not that many, the different things that go into a pricing model, and evaluate them on an individual basis, so you can find where the holes are, so you can find where the risk is, so you can figure out, how am I going to lose, and where can I win, and how am I going to lose? And that's your job as a risk management person.
Yep. So here we got the 95-100. It's a negative gamma position, but it's a positive theta. So here's another example, Stu, where people go, oh, it's all about positive theta. Fine, but you've also got negative gamma, negative vega. There are trade-offs. There are always trade-offs. If you choose the 100-105, you might say, oh, bummer, I've got negative theta. Yeah, but you got positive gamma, positive vega.
Mhm.
It's not a question of right or wrong. It's a question of what are you looking for? And because these are more of the esoteric concepts behind options, this is why traders make bad decisions, because they think everything is like stock. I think it's going up, I buy a call. I think it's going down, I buy a put. That's all I need to know. There's so much more to it. And these are some of the things that we actually coach and talk about in our Q&A classes. So the thing to understand now is that identical deltas do not mean identical outlooks.
Yeah, they very rarely will.
Very rarely. Yep. Okay, so let's take a look at our third one. As always, please check out marketrebellion.com/get started. Tremendous, lots of educational videos in there, all free. I don't even think you need an account or an email address to, I think you can sign in.
I don't think you do either.
I think you can just go right to the website, get all kinds of free stuff. Because remember, there's lots of places that will give you information on the web, but you got to be real careful who you're listening to. There's also a lot of, let's say, bad stuff, to put it politely, out there. Okay, let's take a look at myth number 3. I love this one, Stu. How many times do we hear this? Early assignment is a risk for vertical spreads. Now, in some cases, it might be. For some strategies, actually for some European cash settled index options, certainly could be. But for your equities, is early assignment a risk for vertical spreads? This is the myth that everybody thinks.
They are far and few between.
Very, very few and far between. So let's take a look at this. Let's look at our debit spread, where we buy the 100-105 call spread. Again, we're going to buy the 100 call, sell the 105, net debit of 3.
Yeah.
Question is, what happens if you get assigned early? Well, now it becomes a guaranteed sale. Notice when you sold the 105 up here, it might sell for 105. It depends on the person.
Yeah.
Yep, it depends on the person who bought that 105 call if they want to exercise it. It is not a guaranteed sale.
Yeah, let me step in here for 1 second. You cannot get assigned unless somebody exercises.
Correct.
Keep that in mind. And
you can choose to exercise, but you can't choose to get assigned.
Right. And in order for somebody to want to exercise, there needs to be some economic benefit to them. Otherwise, they wouldn't do it, right? If they had an economic disbenefit, or that's probably not the right word, but if they were going to lose money on the exercise, they wouldn't do it. So if they were going to exercise, they need to have an economic benefit. Then, and only then, might you get assigned.
Right.
It's not even a guarantee, right? You're in a pool, right? Unless 100% of the pool exercises, you might not get assigned.
Right.
You have no control over the assignment, but you did sign up to get assigned if you saw it through at some place. It's your obligation.
Yep. But we are assuming that the stock would have to be above 105 before somebody would even consider it. Well, right now,
it wasn't, Bill. Is that a good thing or a bad thing?
Well, that would be a good thing. But even if it is, we're talking about early assignment right now. The thing to notice here is that it becomes a guaranteed sale.
Yeah.
If we just had the vertical spread, we might get 105. But as soon as you get that notification the next day, broker's going to say, hey, you sold your shares. Now we know for sure that we've got the $5 guaranteed. So all that
And-
happens is you get your guaranteed maximum profit early.
Right, because remember, guys, you still have your $100 call, which is your right to pay $100.
That's right.
So now half of the equation just got done. Right?
That's
now,
right.
Now it's up to you. You still have your right. You want to go ahead and exercise your right, go for it. If not, don't. It's still, the $5 is still there.
Right. You own the more valuable option. So as Stu said, you could exercise that call, close it out, take your $5, say, thank you very much for giving me my $5 early. Now, sometimes people say, well, wait a minute, where would I get the cash to exercise? Well, you just got paid $10,500 or 105.
Mhm.
Take 100 of it, exercise the call, walk away, take your $5 guaranteed and early. So that is not a risk at all. However, what are professional traders going to do here, Stu? We're not going to exercise that call.
Nah, I would never exercise.
And so it's going to change the directional bias. So here's what's going to happen. Here's our risk graph that we saw before. We get assigned on the 105 call. Remember, you can only get assigned on a short position. We have the right to exercise this. So if it's an assignment, it means that the other person exercised. The stock, let's say, and it doesn't really matter, but it's up here somewhere. Now what happens? We are short stock at 105 because we have the obligation to sell shares. I'm assuming we don't have the stock in the account. You're still going to get hit for a short stock position because the exercise is always for the stock. Everybody says, oh, they're going to take my leaps option away. They're going to take my, no, they won't. It is always for the stock.
It's called the deliverable, right? That's what options are. They deliver
Something.
shares of stock.
Right, which is called the underlying. So now we have a short stock position. That's here from the assignment. And we've got our long call. You heard Stu talking about synthetics. We are now long the $100 put. A synthetic position just means that it looks, acts, feels like a long put, even though we're using different assets. We're using a short stock position and a long call to make it behave like a long put. So look what happens. We started off like this, maximum loss of 3, maybe get a net gain of 2 because we got a $5 credit, maybe. But the second we get assigned, we shift from the blue to the red. We've got our guaranteed $2 right here, and we flipped from bullish to bearish. We have an out of the money put with unlimited potential gains. So this is why Stu said that we would most likely just hold on to that call, and this becomes a free lottery ticket. We've already got our $2. You might as well let this thing ride.
Yeah, and what I know what people are thinking here, because I run into this every day. People are thinking, yeah, but I don't really have the put. That's right. You don't have the put. But what you have is you have short shares of stock. And the short shares of stock can theoretically go down to 0. And the long call can as well go to 0, but it can't go below 0. So when the call, say the call's $5. So when the call goes to 0, you're out $5. But when the stock goes down 10, now you made $10.
Yep.
Right. And that would be at 95, which would be the same price as the synthetic put, which is on the 100 line. So that's why Bill's saying it's a synthetic put. Yep. It's the same money, but what you've created is you've created opportunity to the downside. Whereas if you exercised your call, you still got your $2, but you've taken away that opportunity.
Now you've got nothing. Right. You don't have the free put anymore.
You don't have the free put.
Might as well take it. Right. Now,
free is good. I like free. Free. If it's free, it's for me.
Let's take a look at this one. Do we get the same outcome for credit spreads? That was the debit spread. So the question is, can we lock in a guaranteed gain? And is it going to harm us? Is it a risk if we get assigned on a credit spread? Well, let's go take a look. We've got the 100 put, sell the 105, a net credit of 2. What happens if you get assigned early? Well, you do get a benefit that you now have unlimited gains, whereas before you had limited. But you maintain the same bias. Means that if you were bearish before, you're still bearish. If you were bullish, you're still bullish. Notice with the debit spread, we flipped. We flipped from a bullish vertical spread to a bearish position, a long put. But we're going to maintain the same bias, but there's no guaranteed profits. And the part of the reason is we also we maintain the same maximum loss because we're not in possession of the more valuable strike. So this is something that a lot of the credit spreaders all the guys that keep pounding the table about credit spreads don't realize if for some reason you are assigned early, you don't get that free gift. It's still a benefit, but you don't get the guaranteed gains. So let's take a look at our credit spread. Let's say the stock is way down here. Here's our short option. We get assigned, which means we have to buy stock at 105. So we now are long stock at 105. On a net basis, we are long stock plus the 100 put, which synthetically is a long $100 call. So we have switched from this in blue, which is bullish, limited gains, but it's bullish, to this. Now we have unlimited gains. It's an out of the money call. We still have our same potential max loss, but we do have unlimited gains. So notice we didn't get the benefit of the guaranteed maximum gain early. We just free up the upside. So this can also play into your decisions. Should I use the debit or the credit spread? Most of the time, Stu, when we're teaching in Q&A, it's going to be, are we bumping up into resistance? Are we looking at morphs? Why might we break these things apart? And those drive our decisions. It's not the deltas, and it's certainly not fear of getting assigned early.
No, that should never be a fear. And, remember, look, when you sold that spread, you still got your $2. You've created this tail to the upside, just like on the other side, you've created that tail to the downside. And, that means something that carries, weight, right? And, to sharpen the pencil a little bit, you should really start, and we'll do it at another time maybe, but you should really start thinking about on the assignment on the put, you're going to have cost of carry, especially these days, because we're no longer in a zero as a straight environment, but you will have a cost of carry that you should take into account. And theoretically, the markets know that, and they take that into account in the pricing.
Pricing, sure.
Yeah.
Yep. Very, very true. But these are some of the things that you really have to be aware of to make your decisions, and especially when you are trading options. So kind of a little trivia here. Sometimes people say, oh, if you trade a vertical spread, you've got limited risk, limited rewards. Not necessarily true if you get assigned early. This is the only time you can make more than the difference in strikes with a vertical spread is from an early assignment. So that is absolutely debit or credit. It's absolutely a benefit, just a little bigger benefit on the debit spread side. So the main thing we wanted to show you here is to remember that option success depends on taking risk, as does all investing, but it also means ignoring the risks that aren't there. And so we just wanted to share these three, what we think are three of the biggest, most common myths with the vertical spreads, and hopefully help you to become better traders from it. So any closing comments, Stu?
Listen, what I can tell you is, if this whole assignment thing, it really comes from a place of an unknown. People have a fear of an unknown. It's the way we're wired. People fear the unknown. Well, make the unknown known.
Unknown.
Learn about the mechanics. How does it happen? Why does it happen? And look at what happens when it does happen, and see what you're left with coming out of an assignment. And maybe you'll find that is a good thing, right?
Absolutely.
Maybe you'll find that Christmas came early when you got assigned.
When you thought that it was a big risk.
When you panic. That's right.
Yeah, don't ever panic. But hopefully we can round out the week here with another nice little pop in the markets. We'll have to see what NVIDIA is going to do. I can't wait to see how that's going to work out for the next few weeks. But we hope that you learned something from this. And again, please visit us at marketrebellion.com /get started. And we'll look forward to seeing you next Thursday on Coach's Corner. We'll see you then.
Take care, everyone.